And welcome back once again, options traders. Well, for markets like these, with all of the chop that we've had, I've had a number of traders asking about potential morphs for strategies. And I thought I could at least share a couple of simple ones for those who are doing vertical spreads. Now, within vertical spreads, there are two basic camps. There's debit and credit spreads. So I'm going to show you one from each, but I'm also going to show you that some work better in some conditions and others work better in other conditions, as well as some things to be careful of before you go breaking spreads apart. So before we get into the details, as always, if you could please click like, it would be very much appreciated, and it is definitely helping to promote the channel. So let's get started with vertical spread morphs. What are these? Well, recall that a morph simply changes the shape of your risk graph. That's a very basic definition of a morph. You're going to change it from, let's say, bullish to bearish, or maybe you are unlocking some gains, or maybe capping them off. Anytime you're making a change to the shape of that risk graph, it is a type of morph. And there's a lot of reasons why we might want to morph, and this is something that professional traders just live by. As markets change, your positions need to change as well. And usually morphs can also allow us to capture some profits but still stay in the position. But the thing that I wanted to talk about here, mostly for the vertical spreads, is that debit spreads morph in the same direction. Sometimes you'll hear traders say that debit spreads morph in the right direction. And what that means is that if you were bullish before, you are going to be bullish after the morph. In other words, that underlying has moved in the same direction as your initial outlook. Credit spreads, on the other hand, morph in the opposite direction. If you were bullish before, they're going to turn bearish. So sometimes you'll hear traders say that credit spreads morph in the wrong direction. The stock has actually turned around and started heading in the wrong direction on us. And in those cases, this might be a time that we might want to morph and actually flip our bias. But regardless of the morph for these vertical spreads, the way you're going to do it is to just buy back the short option. Whether it's a call or a put, debit spread, credit spread, doesn't matter. You just buy back the short option. Now, there are other morphs, some of them a little bit more complicated, but this is a very simple one that every options trader should know. So for example, let's say that you buy the 100-105 vertical call spread, and let's just say that you spend $3 for it. This is a net debit trade. This would be the resulting risk graph. You are long the 100 call. There's a bend. We get another bend at 105. Our maximum loss is the amount spent, $3. And because there is a $5 difference in strikes, then the most the spread could be worth is $5, thereby leaving us with a potential $2 gain. But remember which options we have. We have a long $100 call and we have a short 105 call. We are bullish, more of a neutral to slightly bullish, but it's still bullish nonetheless. What did the morph say? Morph said to buy back the short option. So here you would buy back that short 105 call. And when you do this, you are going to unlock this limited cap right here because you're just going to be left holding the long $100 call. The problem is that traders often think they are moving from this blue to this red. And they say, oh, I'm going to unlock all of these wonderful potential gains. Well, the first thing is, yes, you are moving from bullish in blue to even more bullish in red. That's what we meant when we said that the debit spreads morph in the right direction or the same direction. We were bullish before, we're still bullish. This morph just allowed us to capture potentially unlimited gains. But the risk here, the thing that you've got to be careful of, is that this is not exactly the way that this graph is going to look. Why? Well, it depends on what you paid for the $100 call. Remember, all I told you is that you had a net debit of $3. Well, does that mean that you spent $4 for this option and sold the 105 for $1? That's a net debit of $3. Or did you spend $10 and sell for $7? That's also a net debit of $3. So when you get into volatile markets and these option prices are getting really expensive, which is one of the reasons that traders will turn to vertical spreads, we have to remember what our cost basis is. So if you initially paid 10 for this option, this is what it's going to look like. You're going to morph from this blue to the red, and notice that your maximum loss is now pushed much further down. And here, this is even assuming that the price that you bought this option back is the price where you sold it, which probably isn't going to be the case. Most of the time that traders will buy back, in this case the 105 call, is because the stock is above there. So yeah, you might have sold it for 7, but you might end up buying it back for 8 or 9 before you realize that you'd like to unlock these gains. And that's only going to push this red curve even lower. So even though the morphs can be very beneficial, you have to be careful in how you're approaching them. And if you spent a lot for the long option, I would be very careful about morphing them. Now, what about credit spreads? Well, let's say that you sell the 100-105 vertical put spread. To do this, you would buy the 100 put, you would sell the 105 put. Notice it's exactly what you did for the calls. You bought the 100 call, you sold the 105 call. You're just going to look on the opposite side of the board and do it with the puts. The difference here is that you are selling a higher strike put. And we know that higher strike puts have to have more value because they give you the right to sell these shares for more money. So this is going to result in a credit. And if the debit spread was 3, what's called the corresponding credit spread should be 2. Corresponding just means that we're using the same strikes from the same expiration. So in that first example, we had a debit of 3. This one theoretically should be a credit of 2. So if we sold this spread, this is what our risk graph looks like, exactly like the call spread. The difference is that we don't start down here with a cost of 3 and hope that the stock rises and gives us a maximum gain of 2. We're starting up here with a credit of 2. But when you sell the spread, it's a liability. I emphasize this every single time, and I still hear so many traders that don't get this. When you sell a spread, it is a liability. That does not make it bad. It's just that it's not an asset. You have an obligation equal to the difference in strikes. So if you received $2 credit and you now have a $5 obligation, your maximum loss is 3. Exactly what we saw for the call spread. So once again, we don't choose a credit spread just because we think we like the word credit. If it's the corresponding credit spread and there are no skews in the markets, chances are it's going to have exactly the same max gains and losses as the debit spread. So why might we consider a credit spread though? Well, let's take a look at the options that we have. We are long the 100 put and we are short the 105. What did the morph say? The morph said to close the short option. So here we're going to buy back this 105 put, and that means we are now long a 100 put. But take a look at what happened. We were bullish, or at least neutral to slightly bullish on the blue curve, but once we buy back that short put, we're just holding a long put. So we flip from blue to green. See, now we have gone from bullish to bearish, and we've also unlocked all of these potential gains if the stock or the index is falling. That's the reason for the morph, or at least choosing the credit spread for the morph, is that we think that if the stock is going to change directions, you might want to lean towards the credit spread. On the other hand, if you think the stock might break through a level of resistance and continue in the same direction, then you might want to lean towards the debit spread. But as with the debit spreads, this is not really going to be your risk graph. Everybody thinks that it is, that you're just getting this freebie of unlocking all of these gains. Remember, we have to figure out what you paid for this, in this case, the $100 put. You're probably going to look something more like this in red, where you're going to shift this much further down. So I like to show this because it is a very helpful morph. It's a simple one. It's one that's used quite often by professional traders, but it also emphasizes why you have to understand the details. Because if you don't understand even this little piece about the change in the cost basis, you could end up actually taking more risk than you had intended. And so this is why it's so important to understand all of the details for all of your strategies if you're going to make the best decisions. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course. strategy lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.